welcome to Money Matters. My name is Jim Butler with Markham Wealth, and my guest today is Mike Dever of Brandywine Asset Management. Hi, Mike.
Hello, Jim. How you doing? I'm not
Good,
actually
good.
your guest. I think Mike's going to be your guest, but
Co-host. Thank you.
that's all right. I didn't want to slight him from, his big day, right?
So before we get to our guest, we can chat a little bit about some current developments that will really stay with us for most of 2024, and I would say even beyond. There's never a shortage of pundits in the market trying to anticipate what actions the Fed's going to take and the impact that those decisions have on interest rates. And it wasn't too long ago, even though we don't want to predate ourselves with the show, of course, but earlier in the year, there were expectations that, the Fed may in fact start cutting interest rates, not once or twice, but as many as 6 or more times, which would have the potential of re-stimulating the economy. Let me pause just for a moment and ask you what your thoughts are just as we look forward into the rest of 2024.
I think for the most part, the economy does not need re-stimulation. It's responded well to the rise in rates. In reality, they are just sort of back to more normal levels, based on where inflation is at this point in time. And markets are responding well to that because the economy has been growing. Companies are producing profits. Not everywhere. There's definitely laggard areas, but for the most part, it's been a strong economy, obviously strong employment, and I don't think there's a need, and I think that the Fed's starting to recognize that, to lower rates for any sort of stimulus purpose. It might be something they want to keep in the bag a little longer as well, even.
And, so I agree with you. I do think the indicators are pointing to still strong employment figures. And at least so far in the first part of the year, the CPI and other inflation measures are maybe not as low as the Fed would like them, but certainly not as high as they were 12, 18 months ago. And so the economy is moving in the right direction. But to re-stimulate and add additional money into the system, I don't think is really anything that they're interested in doing at this time. What I do find interesting is the market expectations still seem to react to the possibility when there is a Fed meeting and Jerome Powell speaks and offers some commentary, the market will have a knee-jerk reaction and move up or down.
Right. I think you can ignore those days. I think the day going in, the day of, the day after, I mean, it is, you described it, it's noise. And I don't know that it has any lasting impact on what's happening in the underlying economy. And when you really get down to it, okay, they drop rates 25 basis points. That's really a yawner. I mean,
Right.
that's not going to be the at the margin game changer for the economy. So I kind of view it as no matter what the Fed does this year, I think we still have a reasonably strong growth path right now. If it starts sagging, they've got the dry powder, to bring rates down if they want to do that. But I don't think it's something that's essential to keep
Right.
things humming along.
And in the meantime, one other facet that is available to investors is very attractive short-term interest rates. With short-term T-bills, say anywhere from 12 months or less to maturity, the rates being, let's just ballpark it and say anywhere from 4.5 up to 5.25 for short-term money. Those are pretty attractive rates, and that's still very liquid.
Hmm.
And gives people kind of a short-term parking lot, so to speak. So they can build some liquidity while they decide what long-term needs they might have. And I agree with you. I think the long-term trend is still headed in the right direction. And as we get through this economic cycle, and then of course, the election cycle, then, we'll see what happens into the fourth quarter and then into next year.
Yeah, I mean, there's going to be, in stock market, there's going to be sell-off periods, but I think the talk of, well, I'm starting to hear the B talk, the bubble talk. I just think that's way premature. I've lived through plenty of bubbles, and what I've always learned is that I'm usually one of them that's way ahead of the game, saying, "Whoa, this thing's ready to end," and the next 2 years, it just keeps going on, and because what we're seeing in the broad market is nothing like a bubble. We're seeing it in this concentrated Magnificent Seven, for example. But that's it. And even those, like Nvidia is growing into its earnings. I mean, it's a little crazy to see what it's done, but the reality is it's walking the talk. I mean, its earnings are actually taking off. It's not a dot bomb, from 1999 that was just all hyped up. It's a real business that's growing.
Yeah. I agree with you. Well, good comments, good observations. And then maybe what we can do is hop to our question real quick. The viewer Martin Ruth in Philadelphia has written a question, and it's, do you have any retirement tips, Mike, that I can use for the future?
Well, that's obviously a very general question. So I'm going to give a broad answer that's more general as well, in that just first of all, retirement tips, pre-retirement is just save as much as you can, as soon as you can. And, a lot of people, they don't have that option. They're already in their 40s or 50s. They maybe didn't start saving enough earlier, but certainly anybody that's younger, don't think that this is something that's in the far off realm. Start saving today, and let the compounding take effect. And then the second is, and one of the advantages that came out of the Pension Protection Act 2006 is, prior to that, a lot of people put their retirement plan money into money market accounts because they were afraid of taking risk. And now the majority of the money goes into target date funds, which certainly, if you're decades away from retirement, has a larger equity component to it. Yes, you take on more risk, but potentially get much better compounding over that time period. So save money. Don't worry about investing it too aggressively early on, and then make sure you live within whatever the means are once you retire.
Right. Good. Great. Thank you. Good answers and good insight. Hopefully, Martin, that helps shed some light on your question. And if you have a question you'd like our panel to address, feel free to write in.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, we're going to take a little bit of a turn away from the economy and have an interesting conversation with our actual guest, Mike Trabert, who is a partner and CPA with Markham LLP, the international accounting firm. Welcome, Mike. Good to see you.
Hello, Jim.
Mike.
Thank you. Hello, Mike.
So maybe to start things off, just in a very general sense, Mike, can you give our viewers, a brief background with regards to what you do within the firm and then your area of specialty?
Okay. Well, I am a certified public accountant by trade, been practicing that for decades. And in probably the last decade or so, I've been much more involved in the value acceleration and exit planning arena. And we'll talk about that a bit more. So a couple of my credentials do revolve around exit planning through the Exit Planning Institute, through the International Exit Planning Association. And so I've kind of transitioned away somewhat from financial statements and tax returns that CPAs do, and I still have my hands in that, but focusing more on building value and getting owners ready for their ultimate transition, whenever that may be.
So define exit planning for those viewers who may not understand it completely.
Absolutely. So the term we use in Jim is really value acceleration and exit planning. It's kind of two components to that. So the value acceleration piece of that is building value in the business. Then exit planning piece is ultimately transitioning that business by whatever method, and we'll talk about that probably a little bit, whatever method you so choose, whether it's a family transition or outright sale, and whatever time period that is, whether it's 1 year from now or 20 years from now. And we think in the context, when we talk about exit planning, that, and we'll probably talk about this as well, but it's really not a future event. It's a present event that you're always building towards. And I somewhat liken that to the retirement tip question that came in to Mike, in that, and his answer there was save as much as you can, as fast as you can. And I kind of liken that to this arena, in that you want to build value as much as you can, as soon as you can, also because stuff happens. We talk about what we call the 5 Ds: death, disability, divorce, disagreement, and distress. So 50% of business transitions are under the 5 Ds. So you do want to be ready for that transition.
So my sister used to help out with realtors in staging their houses prior to the sale.
Mm-hmm.
Now, obviously, it's something to make sure that people see the true value and what the property looks like. Not everybody can visualize it. With you, it's all pretty much numbers, so people can look at it and see the numbers. How long does it take to prepare? I mean, the value acceleration, is that a 1-year project? When somebody comes to you, what's the general gap between that first discussion and them actually setting up to do the exit?
And I'm going to answer that question, Mike, with a sign that's at the gym where I work out. And the sign has a picture of a middle-aged or maybe a little older individual. And the sign says, what's the best time to work out? The best time to start working out was 10 years ago, but the next best time is now. And so I had this very conversation with the client just yesterday. He says, hey, Mike, I just read the book that you gave me. It's about building value and transitioning to business. And he said, I should have done this years ago.
Yeah.
And I said, well, John Doe. And I told him what I just told you.
Yeah.
And so in answer to the question, Mike, is you really want to get started early on. And when I say early on, again, we like to say that we want to change it from the future tense to the present tense, because you don't know when you're going to have one of those 5 Ds I mentioned, or you're going to get that unsolicited call on the telephone. Hey, is your business for sale? So you want to be ready to transition.
Hey, Mike, what's the macroeconomic outlook for business owners today in 2024, in your opinion?
Okay. So just to kind of set the framework, there's about 6 million businesses in the U.S. That have employees. And over 90% of those businesses are under $5 million in revenue. And most of the rest of those are between 5 million and 100 million. And many of those businesses, 51% actually, are owned by baby boomers. And so what is the significance of that? Well, baby boomers all will be age 60 within the next year. And with them owning about half the businesses, there's going to be a plethora of businesses available for sale. And so what I say now is it's a seller's market, meaning there's a lot more buyers than sellers at this point. And I used to say it was an extreme seller's market, but that pendulum's going to swing because it's supply and demand. With all these aging business owners, there's going to be a lot of businesses available for sale. And so over 50% of those businesses are projected to transition in the next 5 years. and over 3/4 are projected to transition in the next 10 years. So I think really only the good and great businesses, the ones that are prepared, are going to have the opportunity to sell. And those businesses that do sell might not sell at a high of a value, as high of a valuation, because of the supply and demand.
So that gets back to the best time to start was 10 years ago, right? So you want to make sure you're rising above, you're the there, and not down there duking it out trying to sell your business with all the other baby boomers that are selling their business. So
Right.
we talk about when to do it. I mean, how do they go about doing it? You mentioned a book. Is there a book that people can read through, today, and that starts getting them prepared for an exit 10 years from now?
Part of what we talk about in what we do is it's about awareness and education to the business owners. And so the owners can talk to their advisors. There's an organization out there called the Exit Planning Institute, where you could find an advisor maybe in your local area, not that it has to be a local area. And there is a methodology and a process to this whole preparing your business for transition. And so the Exit Planning Institute that I mentioned, they just did a state of owner readiness survey, which they last did 10 years ago. And the results of this survey just came out. And so 69% of business owners say that exit planning is a priority. And so for you business owners that haven't made it a priority, your brother of other owners is making a priority. So they're likely to be more ready to transition when that time comes. And so the methodology then that we talk about then, Mike, there's really kind of three gates. It's a discover, prepare, and decide. And what we mean by that, in the discover phase, we usually begin that, almost always begin that process with a valuation of the business in correlation with an assessment of the business. And so, as you gentlemen may know, most business owners do overvalue in their mind what they think their business is worth. And so a great statistic that came out of this recent survey is, so only 10 years ago, only 18% of business owners had a valuation in the last 2 years. And now I'm blown away by the stat, but it's 60%, 60% of business owners have had a valuation in the last 2 years. So they're much more attuned to the realistic fair market value of their business.
Could that also be because they're getting closer to, in their mind, to selling, and they want to know that valuation, like you were talking about? There's that bulge coming through.
There is that, and one would think that, but interestingly, the baby boomers don't have as much interest in exit planning, although you think they would, as the millennials and the Gen Xers that are coming up and becoming business owners of their own, and they're thinking more long-term. And one of the things we also like to say is we like to change the terminology from exit planning really to business strategy. They should be thinking about this early on in the life cycle of the business. When I talked about one other comment on that, then Mike, and then we can move on. But I think it's important to do an assessment of the business, and I'll define that in conjunction with the valuation. And let's say we have two $10 million revenue businesses, and both drop $1 million to the bottom line. So on paper, one would think that both those businesses are valued at the same amount. But say business one has a great recruiting process, onboarding, training, leadership development program. They have a strong customer base, recurring customers, contracts, good customers, paying customers. They have processes and systems that are built out and documented. They have a good culture, good brand. Business two, still 10 million top line, 1 million bottom line, and the owner is the business. And what we often say, if the owner is the business, there is no business. So that's why it's important to do an assessment of the business. And when I say assessment, the tool we use, it's about 150 questions, and then we correlate that assessment to where they fit in that range of value. So in our simple example there, business one would be valued a lot more than business two, where the owner is the business. And that's really the starting point of this methodology, knowing the value, identifying what their value is, and then moving on from there, protecting and building the value.
So I take a business owner who is curious and interested, but haven't really done much planning up to this point, but recognize that sometime over the, call it 5 to 10 years, or a certain time period, they need to do something. So how can they start enhancing the value of their business today to get ready for that point in the future?
Okay. A lot of what we talk about is what we call the 4 C's. So 4 types of capital. So human capital, customer capital, structural capital, and social capital. And so human capital is your employees, and some of the things I mentioned previously fall into that category. The customer capital, again, some of the things I mentioned there. Structural capital being the process of procedures, etc., and the culture and the brand being the social capital. So if you take unless the business is very capital intensive, when you think about the value of a business, and let's just say in that hypothetical $1 million bottom line, and let's say that's the normalized, the reported and the normalized income. So in our heads, when somebody says, what's a business worth? We start with the 5 multiple. So 5 times $1 million is $5 million. And so usually 3 or 4 of those 5 points, if you will, in that multiple are the intangible assets of the business. So there's 4 types of capital: human, customer, structural, and social. So you want to build that up. And so through the assessment, one of the things the assessment tool does, it indicates the strengths and weaknesses of the business. And then also within that 40-page report, we'll put our recommendations of what we believe the business should do to begin to first protect value, and then what you want to do before you grow value, and then to build value. And honing in on, there's like 26 different categories within that assessment. And one business owner, we just got done doing the assessment, $70 million company at the time. And he says, Mike, this is not just a cerebral exercise. This is the essence of running a business. And the interview usually takes 2.5 to 3 hours or so. But we drill down pretty deep. And so we talk about areas for improvement. And so the assessment tool gives a good place for the business owner to begin to protect and then build that value.
How important is it to work with the executive team, assuming there is one, maybe meaning 2 or more folks that are in senior management positions? Or is it sometimes better actually just to work with the owner, and that might just be 1 or 2 people if it's family owned?
Yeah. And that depends. And it depends. And we've done those 2.5, 3 hour interviews with just the owner. We've done it maybe with owner and the next gen, which might be in a business. We've done it with owner and maybe the CFO. We've done it with a couple owners. We've done it with 3 separate interviews of maybe the owner, the, say, general manager who runs the day-to-day, and say the strategic vice president separately. And then it's interesting sometimes how you see how their comments align or don't align. And one of the early things you do in that situation is make sure that all 3, in that case of the individuals, are on the same page. I think also important then, Jim, is, and you talked about the leadership team, and when we talk about building value and enhancing value and transitioning, one of the most important things a potential buyer will look at is, okay, when John Doe owner walks out the door, what's left as far as the team? So it's important to have the team built up and ready for that transition as well.
So I have a question that I'm a business owner. How do you charge for it? Do you is it an hourly? Is it a for the whole
Mhm.
service? Do you take a piece of the action on the exit, or is it combinations?
Well, it is combination then, Mike. And so initially, again, with that valuation and assessment, that's a flat fee to get that done. The valuation is about a 30-page report, about half a narrative, and half schedules. And then we'll sit down with the owner afterwards. And that's usually about a 2.5, 3-hour meeting as well, and review we tell them why we believe the value of their business is this amount. Sometimes they don't like that answer, but that's our humble opinion. And then again, assessing and correlating that as well then.
So you had mentioned five different caveats a few moments ago, and we're kind of winding down with our time here, Mike, but
Okay.
maybe hitting on a few key points. Are there what's also known as 5 stages of value maturity? I've heard that term.
Yes. So 5 stages of value maturity, then Jim and Mike. Stage 1 is identify value, because the owner's really got to know, for a variety of different planning purposes, what's the true value of his business. Once we know that value, it's protecting value. Stage 2 is protecting value. So you want to de-risk your business and de-risk yourself personally. Then once you've done that, some of those being low-hanging fruit, then you undertake building value in the business, and again, focusing on the 4 types of capital to build value, that intellectual capital in the business. So that would build value. Stage 3. Stage 4 then is harvesting value. So within that stage, we talk about 7 different exit options and the pros and cons of each, and educating the business owner on that. And another great statistic from the survey that was just done was 10 years ago, only 34% of business owners were aware of all the exit options. And now it's double. It's about 70% of owners are aware of all their exit options. And so they can make a more educated decision as to how I want to transition out. Stage 5 then is manage value. Part of what you folks do and do very well is, so it's personal financial planning and estate planning. And even though it's listed as number 5 stage, it's really done throughout the entire process. Personal financial planning and estate planning. And again, a couple stats that are out there: only 30% of business owners have an updated estate plan, and only 24% of business owners have a will. Crazy to me, but only 24% have a will.
Yeah, I mean, interesting. So like you said, not only is there a lot of breadth with business owners wanting to move on because of the baby boom generation, but they just haven't done enough planning up to this point as well. So certainly a need not only today, but it sounds like will continue to allow them to really realize the value of their business. So, well, we've taken our time, and appreciate your insights very much, Mike, with the exit planning process. So thank you to our listeners as well. Our next guest is Jared Armstrong from JAB Camp. And that's something that is also very unique, that addresses the needs of our youth today. And thank you for listening. Hope you picked up a few pointers here.
Thank you all.